thank you all for coming here today. We have, I guess, foremost, there's kind of two sides to our business. We have an investment management business, and we have a mortgage lending business. So we source our funds from investors. We have two pooled funds, a first mortgage fund, Foremost Mortgage Limited Partnership, and Foremost High Yield Fund. And we syndicate. We have a small equity business as well. On the other side of the business, we have mortgage lending. So we take the funds from our investors who kind of trust us with their hard-earned money. They trust us to kind of invest it safely. So on the other side of the business, we're a mortgage lender. So we find builders and developers, and they sink the vast majority of the net worth into these projects, and they trust us to do what we say we will do when we say we will do it, to kind of deliver on our promises. So we have kind of two sides that we try to. We have two sides that we have to kind of honor and respect, and we have about a 37-year history of doing a pretty good job with that. So great to get everyone in the same room. We kind of thank you all for coming. Also, I just want to thank my coworkers. There's about 20 employees at Foremost Financial, and everyone works quite hard to allow us to kind of do what we do, to lend out and finance a large portion of projects across the Greater Toronto area. Is the slideshow? Is the slides working? Some technical difficulties here. Yeah, we have some referral partners too, our mortgage brokers and other individuals who kind of trust us with their relationships to kind of work with us to finance their projects. I'd also like to thank you for that. So over the years, we have a 37-year history. We kind of started financing custom homes at Yonge and Lawrence, and we kind of branched out. So we've been branching out to finance bridge loans on commercial industrial properties, building townhomes, small condominiums, anything that with a strong exit strategy that really makes sense. And so when the zoning changed across Toronto, we saw the missing middle, and we really loved that opportunity. So why we like the missing middle is a bunch of factors came together all at once. So zoning as of right for multiplexes, and now up to 60 stories on major avenues, and now no HST on purpose-built rentals over 6 units, no site plan approval on projects of 10 units or less, and a severe housing shortage which kind of elevated rent. So we like to think that we're kind of helping kind of solve the city's housing crisis, and with great risk-adjusted returns for our investors. So we've financed a number of multiplexes recently, and we've kind of seen we've seen some of them exit. So many of them have actually gone through the full cycle from acquisition to the completion of construction, and we've kind of seen them refinance with CMHC. Let me see. So yeah, I guess these kind of photos represent the previous projects that we were financing. We still do bridge loans. We finance custom homes, industrial, commercial land, but now we have an increased focus on the missing middle. So I guess we kind of have the full batch of missing middle projects that we financed, and we've kind of been watching them closely to see what types of takeout financing they get with CMHC. So we kind of have a sampling of, so the first kind of batch, I have 3 examples on my slide. The first example, I think we had about $2.5 million lent to this group, and they were able to get a $3.4 million takeout financing loan facility from CMHC. So there's about a $900,000 equity takeout upon completion. So they retain ownership of the project, and we have a pretty big margin of safety between our loan at $2.5 million and their takeout financing with CMHC at $3.4. We have another group. I think we lent about $3.4 million, and they kind of took the full course. They leased up the property, and they had about a $4.4 million takeout loan with CMHC. So they were able to take about $1 million of equity out of the property. So we're still, CMHC is constantly changing the rules. So we always build a margin of safety into our loans just to make sure that if CMHC ever changes the program, changes what they're lending on, our clients will be safe because they're able to kind of take out our financing with a kind of cheaper long-term financing, and kind of move on to the next project. So is the remote? Okay, next slide. Next slide. Yeah. So, could you go back? And so this map, this map is the missing middle projects that we've financed to date. So you can see a few clusters. The vast majority are in the city of Toronto, just because the development charge exemption, the zoning as of right, is so attractive that the missing middle generally works in the city of Toronto. In Durham region, we've seen some great projects too, a lot of semi-detached triplexes, other developments. We've seen some in Kitchener-Waterloo, in Guelph, and one into the Niagara region that was extensive renovation. So they kind of cluster. Next slide. Yeah, so this is the example. So it was actually $1.9 million of equity taken out as one project. So it's pretty wild. We like to have kind of conservative exit strategy, because if they need additional funds, they're able to get it from CMHC or another one. Next slide. Yeah, and next slide. Yeah, and just because you're able to get additional financing from CMHC doesn't necessarily mean it's the best idea. So some of our clients, they can get additional financing, but they don't need the leverage, so they haven't been taking it. So so here's an overview of some projects that we have been financing. This is a 4-unit residential condominium. This I guess nearing completion. Once complete, so it's a 4-plex right now. They're gonna register them as 4 condominiums and sell off the individual units. And then I guess in the earlier slide, I kind of mentioned that some of our developments are kind of clustering together. So this is actually one site in particular where we actually have 3 4-plexes with garden suites all next to each other. So on the left, we have a great builder developer that we've been working with for a while that's been pressing us. On the middle one, we have a builder we've been working with for probably about 10 years now, financed a bunch. And on the right is actually owned by another our builder. So we have one street, 3 projects, 3 different builders. 2 of the 3 are financed by Foremost. And also, I guess we kind of started the core of Toronto, and now the multiplex are kind of branching out. This is one example in Etobicoke. It's kind of branching a bit further out for the suburbs, and it's on a major street. So our clients are building a 4-plex, and they're building a garden suite in the back. There was a tree in the back which they couldn't cut down due to the garden suite, so they had to kind of build around it. But but unfortunately the tree died of natural causes, so the tree is no longer there. But they're able to build that. So we've kind of been seeing some fairly innovative projects across the city. Next slide. So based on our experience, based on the number of projects that we have financed, we've learned some things. So we've been finding that projects with parking have been leasing out a lot faster than projects without parking. And especially the further you get from the core, the more parking matters. But if there's street parking available, if you're near a major subway line, yes, you could get away without parking, but it's a great deal easier. With a parking spot, which we kind of value. And quality location, in a desirable location versus a less desirable location, the hard costs are quite similar. I guess you get nicer finishes, but so a 2x4 in call it Forest Hill is the same as a 2x4 elsewhere. So we kind of like seeing projects in more desirable areas where people are willing to kind of live close together to versus in a less desirable area, there's more competition from other single-family homes and townhomes that are affordable to live in. We have financed a number of projects on 20-foot lots. They're more challenging to build. A lot of our clients who have built projects on 20-foot lots says never again. They would only build a 25-foot or longer. But if you have a great development team, 20-foot lots are probably fine to build on. Competent builder is critical. This is not, you shouldn't really have, it'd be a very expensive learning opportunity to hire the wrong builder. So it's important to have the right team guiding you. And leverage, I guess CMHC, their rules are constantly changing. So it's best not to lever up too much, because if there's a rule change and your project is not eligible for the financing that you require or you thought you'd get, it's best to have a margin of safety so you're still able to exit and move on to the next. And we find also partners, a lot of our groups that have been quite successful, they've been kind of great partners to kind of add value to each other, and they share resources, they share experience, they share financial resources, and they're quite more successful. We have some individuals, which has been great, but we just find partners have been consistently pretty good. Next slide. And then I guess our outlook for 2026, we're a bit cautious on the market. I guess as a sign is, I guess winter is coming. So we're projecting for 2026, based on the softening economy, lower rents, lower new and resale prices, and on the other side, we find the value of land would likely fall a great deal more than the value of new and existing homes. Next slide. So we have kind of three key things we look for in a project. Number one, the project has to make sense, good return on investment, good metrics, less risk. An experienced team. Do you have the experience on your team to get the project done on time, on budget, and financial strength? I'm sure you all know things happen in construction, so it's best to have contingencies in place in order to kind of overcome cost overruns or delays. Next slide. And then, so there are some storm clouds on the horizon, but we find that there are reasons to build in this environment. So number one, in 2026, land prices will be lower. So we find it would make sense for builders and developers to take advantage of these lower land prices. And also, I guess governments are printing a great deal of money, so purpose-built rental homes can be a great store of value. So rather than buying Bitcoin or gold, we think long-term, the Toronto multifamily would be a pretty good asset to own because it produces cash flow, would be good hedge against inflation. Also, the only demographic of skilled trades in Canada that's growing is tradespeople over the age of 65. Every other demographic of the trades people is shrinking. So we see upcoming labor shortages as the increasing number of trades retire, and not as many newer workers want to enter the trade to replace their aging counterparts. And then, as Chris Spoke and I mentioned, or as Chris Spoke mentioned before, there is a shortage of multifamily starts in Toronto right now. So there are a record number of completions, but those completions will work their way through the system, and there's likely to be a shortage around 2028 or 2029. And and we believe the market will rebound likely 2028, 2029. So you're building today to take advantage of the market in a few years from now. And I guess one of my builder clients actually mentioned to me, we were having a good conversation, he says none of us are getting any younger. So we could wait, but now is the time to build and take advantage while we still have the energy and still have the time.